Let's talk about markets ahead of the holiday shortened trading session. Joining us now, Baird investment strategy analyst Ross Mayfield. Good morning, Ross.
Good morning. Thanks for having me.
Okay, so let's talk about this rally. Does it have legs, or do you think it's just short covering?
I think it has legs, but it requires a soft landing at this point, and that's a 2024 story. But we're basically priced for a soft landing. Multiples gotten extended. Certainly a lot of what's happened, the last couple of weeks is short covering, seasonality, sentiment had gotten pretty bad there in the fall. But for this to continue, you need the economy and the earnings to follow through. And I think that's still a question for 2024.
When you say earnings to follow through, are you concerned about, for example, earnings, keeping with the theme of the morning, in the retail sector at this point?
Sure, you have to be. I mean, the consumer has driven this economy for the last 18, 24 months. They've been a workhorse.
Right.
And there are real questions about the sustainability of that into 2024. We know all the reasons why. I don't know if I'm willing to bet against the American consumer at this point, but I think there's questions about whether this elevated spending can continue into perpetuity with rates, with still inflation pressures, with other things like student loans, housing costs. We know about all that. So I think it's a big question for sure. And I think, the updates that we'll get from the consumer companies on Black Friday, on holiday spending, are going to be really important.
All right, so just a little bit of advice. You're going to want to tune in about 7:10 this morning, where we have retail expert Jan Kniffen coming up, and he has some choice words for those people who have been betting against the consumer. He says you're all wrong, you're all wet, whatever. Let me ask you this question, though. Does your outlook, being thinking that this rally has legs, require the Federal Reserve to ease back on interest rates?
I believe that it doesn't require it. I think if the Fed is cutting in the next 3 to 6 months, it's not a bullish signal. I think they're only doing that if there is something wrong with the economy, or if we have kind of a event like the banking crisis last March. In a perfect world, I think the Fed would tactically bring rates down because they think the inflation crisis has been beaten. You look at the soft landing of 1995, that was the story. The Fed saw no pressures and they eased without needing a recession. I mean, if the Fed holds rates higher for longer through 2024, I think that's really hard to square with the idea that they see a soft landing as well. I would love if the economy could be very strong with rates above 5%, but I think it's hard to see that, and I think the Fed will need to tactically adjust maybe mid-year next year in order to really provide some legs to the soft landing. I think it can happen either way, but I do question the sustainability of the economy with interest rates over 5%.
Ross, I want to ask you this question, not the overall question of where are the profits going to be. I want to know where the profits are going to be that you think the street has not recognized those profits are going to be.
Wow, that's a great question. So, obviously, double-digit expectations for earnings next year. We know that will come down. That's not only the historical trend, but you just look at the outlook for the economy, and I don't think you can get double-digit earnings growth and margin expansion in a year like next year, where rates are going to be elevated, where there's still inflation pressures in pockets of the economy. I do think that, the consumer sector, the tech sector, and then cyclicals like industrials and financials still have some legs. If we're going to get a soft landing, the cyclical sectors are going to be the ones that lead the way. And so I think, the sentiment has gotten pretty negative in a space like energy, in a space like financials, even industrials to an extent. I think there's some profitability and some structural tailwinds there that will continue to play out in 2024. So I think if there's a soft landing, the cyclicals are probably the place to be because they've been beaten up a little bit more, and because tech and consumer has been in focus so much.
Small caps also been pretty beaten up. Do you see upside there?
Probably near term. I think this rally can continue. But again, if higher for longer is the theme, I want to shift towards more of a quality tilt. And I'm a little skeptical of the continued rally in small caps. We know the pressure there from rates. We know the pressure from inflation. You can read the small business surveys and hear all about it. I'm skeptical that small caps have the legs to sustain, even if we get a soft landing, mild recession type scenario next year. I just think there's too many pressures, and I would want to skew quality and up the cap scale just to kind of protect my neck a little bit.
Right. So the cap scale is what's really interesting next year. There's going to be another wave of companies that refinanced during the pandemic that now are going to have to go and get new debt, and they may not make it, right? So there's going to be winners and losers and a lot of stark contrast next year.
Yeah, our partners at Strategas have basically, equivalated rates this high to holding your breath underwater, right? You can do it for a time, but
Right.
every day that passes, a new consumer takes out a 7.5% mortgage and gives up their 3%. A new company has to refinance their debt at a higher rate. The US government, same deal. So every day that rates are in restrictive territory, you feel that pressure more and more. And I think that's the thing, is if the Fed doesn't kind of tactically move rates lower, those pressures just continue to weigh. The big story so far has been this strength in spite of higher rates. But again, every day there's refinancing, there's new debt taken out, and it starts to weigh.